If you're looking to create passive income and build long-term wealth with multifamily real estate, this video is for you. Today, I'm going to share 5 secrets to help you build wealth passively with real estate. Before we jump in, don't forget to subscribe and hit that like button. Like lots of people looking to achieve financial freedom, I recognized that real estate was a great way to build wealth. And when I first started investing in real estate, I decided the best way to do that was to build a portfolio myself. As someone who was working a corporate job at the time, I can honestly tell you that I significantly underestimated how much time and effort went into building a real estate portfolio. I spent hours and hours researching markets and analyzing deals, and when I finally found a deal, I spent even more time overseeing renovations and managing the properties. What I was after, what I really wanted, was freedom, and what I ended up with was a second job. I did successfully build a cash flowing portfolio, but it took a lot of my time and effort to do it. And after actively investing for several years, I started looking for other ways to create passive income and build wealth with real estate. And that's when I discovered apartment investing. By passively investing in apartments, not only did I get all the benefits of real estate ownership, but the best part was I didn't have to do all the work myself. And as somebody who's now invested on the active side and the passive side, I can honestly tell you that passively investing in apartments is a much less risky and much easier way to build wealth with real estate. Since I've started, I've invested in over 1,000 apartment units, and that experience has taught me a couple of important lessons along the way. And today, I'm going to share 5 secrets to help you build wealth by passively investing in multifamily apartments. Number 1, the market is more important than the property. Let me say that again. The market is more important than the property. If you've ever heard the phrase, a rising tide lifts all boats, it perfectly demonstrates this concept. You can have a mediocre property in a great market, and the market is going to do most of the heavy lifting for you. On the flip side, you can have a great property in a mediocre market, and the investment is probably not going to turn out so well. So what are some of the factors that you want to look for in a market? Ultimately, real estate is all about people. You want to be investing in areas that have sufficient population size, and you want that population to be growing. You want to understand why people are attracted to an area and why it's a good place to invest. For example, is there a high quality of life? Is it a low cost of living? Are there certain amenities like access to the beach or the mountains that make a place attractive, that make people want to live there? Aside from that, you want to invest in areas that have strong economic indicators. So ultimately, people move for jobs. You're looking for a place that has a lot of jobs, and you want the area to have a diversified economy. You don't want the economy to be too dependent on one employer or one industry. Think about Motor City, Detroit. You're also looking for an area with strong apartment fundamentals. So what do I mean when I say apartment fundamentals? Ultimately, what I'm talking about is supply and demand. You basically want an area where there is a lot of demand and not enough supply. If you're investing in an area that has an undersupply of housing, specifically multifamily housing, and a lot of demand, it's going to push occupancies up and ultimately rent growth is going to follow. Conversely, if you're in an area where there's an oversupply of multifamily units, you're probably going to see concessions, which is going to drive occupancy down and ultimately rent growth is going to fall. And another thing to look for is areas with high barriers to home ownership. And so one of the best ways to look at this is something called the price to rent ratio. You're basically looking at the annual cost to own a home compared to the annual cost of renting. And you want that discrepancy to be wide. You want a high barrier to getting into home ownership. That basically means there's going to be more people in that market that need to rent multifamily properties. Number 2, the team is more important than the market. You can have a great product and a great market, but an incompetent team is going to turn a good investment into a bad one. When you invest in a multifamily property, you're essentially investing in a business. And a business is only as good as its management. If you're investing in an apartment syndication, you're basically becoming a partner. And in an apartment syndication, there are 2 groups of partners, limited partners and general partners. The limited partners are completely passive, right? They're just bringing money into the deal, they're bringing the initial equity, and they're sharing in the profits. The general partner is the active investor. They have management control over the investment. They're the ones making all the decisions. So you want to know who the general partner team is. Are they individuals? Are they entities? And if they are entities or other companies, who are those individuals behind those entities? You basically want to know who is making the decisions. Ask yourself, does the GP team have the experience and the expertise to manage that investment? You should be asking, have they implemented that business plan before? For example, if somebody's been focused on new development And now you're going to get into, let's say, a value add deal. They're probably going to be less skillful. You basically want to know who the management team is and do they have the competency and the experience to carry out that business plan. Number three, there needs to be an alignment of interest between the general partners and the limited partners. Ask yourself, is the GP team incentivized to perform and provide the projected returns? Basically, you want the GP to have skin in the game. In an apartment syndication, the GP gets compensated essentially in two ways: profit sharing and fees. And when it comes to fees, they should be in line with industry norms. They shouldn't be excessive. The GP should be compensated for their efforts, but the investment should be structured in such a way that they're rewarded for sound management, not just for closing a deal. Your success should be their success. When it comes to profit sharing, a common split would be something like 70-30, where 70% of the profits go to the limited partners or the passive investors, and 30% goes to the general partner. In that arrangement, you can also have something called a preferred return. A preferred return is not a guaranteed return, but it basically means that if there is money to distribute from the partnership, that the limited partners get a certain percentage of that money before the GPs are compensated. Another way to align interests is something called a co-GP investment. And this is basically where members of the GP team will put their own money into the deal. It's always a good sign when the general partner is making their own investment into the deal. Number four, every great investment has a great story. You should be asking what the story is behind the property. It could be something like, it could be that the property has an original owner and they never raised rents on the property. And you might ask yourself, why would they never raise rents? Maybe they knew the people. Maybe they thought if they raised rents that they would cause vacancy and they didn't want to deal with the headache of doing that. Unlike a residential property, the value of a commercial property is dependent on how much income it produces. In the residential world, if you have a neighbor down the street and their house is worth $500,000 and you have a similar sized house, your house is probably worth somewhere around $500,000. In a commercial property, the value is really dependent on how much income that property generates. So if that owner has rents that they've never raised, and maybe those rents are, I don't know, $800, but market rents are $1,000, there's $200 locked in that rent roll times however many units there are in that property. And that's hidden value. That makes a great investment opportunity. Or there could be a scenario where a seller is motivated because they're in financial distress. Maybe they own another property that's not doing well and they have to sell this property to raise money. Or maybe they have a partner who wants out of the deal and they have to sell. Whatever the story is on the property, you need to know what it is, because every great investment has a great story. And number five, and this one is probably the most important, focus on the assumptions, not the returns. I know that sounds a little controversial, and you're probably thinking, Jason, the whole reason I invest in real estate is because of the returns. But hear me out. Remember, returns are projected, they're not guaranteed, and projections are based on models. And those models are based on assumptions. And the model is only as good as the assumptions that were made. It's really critical that you understand the assumptions that are being made. For example, rent growth. Let's say the projections are for rent growth to be 5%, but maybe there's a lot of supply that's just been introduced into the market, and the market can only support maybe 1% rent growth. If that's the case, there's a good chance that that investment is not going to perform according to projections. If it's a value add opportunity, you're likely going to be doing renovations. What's the renovation timeline, and is it reasonable? If it's a 100-unit property and 70 of those units need to be renovated, does the plan say that they're all going to be renovated in the first year? Does the model account for increased vacancy during that time? If you're going to be doing renovations, those units are going to be vacant while you're doing them, and they're not going to be generating any kind of cash flow. And does the model phase in those rent increases over time, or does it start including them from day one? And most importantly, make sure the GP understands and can communicate the risk profile on the investment. So what do I mean when I say risk profile? I'm basically talking about stress testing the investment. And this is often done through something called a sensitivity analysis. So for example, the business plan might call for a refinance, and there's going to be an assumption made about the interest rate that's going to be available when you make the refinance. Maybe the business plan calls for a 5% interest rate. Well, what happens if you go to refinance and interest rates are 6 or 7%? What does that do to the investment? That needs to be stress tested. Another stress test would be for break-even occupancy, which is basically the minimum amount of occupancy that you need to cover all the expenses from the property and still make your debt payments. For example, if the business plan calls for occupancy of 95%, but the break-even occupancy is only 90%, there's not a lot of wiggle room. In the event that something happens and occupancy drops below 90%, that property is now in trouble. Compare that to another investment where maybe the business plan calls for 95% occupancy, but break even occupancy is 80%. There's a lot more wiggle room, and that second investment is much less risky than that first investment. Remember, investment returns are just projections. Make sure you understand the assumptions and decide for yourself if they seem reasonable. Doing so will help you avoid taking unnecessary risks and help you invest with confidence. So if you're looking for a hassle-free way to create passive income and build long-term wealth, passively investing in apartments is a great option. But before you jump into an apartment investment, make sure that you understand the risks that are involved. And to help you do that, remember these 5 key points. The market is more important than the property. The team is more important than the market. There must be an alignment of interest between the limited partners and the general partners. Every great investment has a great story, and focus on the assumptions, not the returns. Understanding each of these elements will help put you on a path to building hassle-free long-term wealth. If you got value from this video, I'd appreciate it if you'd hit the like button so we can reach more people in the algorithm and help others on their journey to financial freedom. I'd also love to hear your thoughts and answer any questions you have, so make sure to leave those in the comments below. And if you'd like to learn more about creating passive income and building long-term wealth without the hassle of doing it yourself, you can access my free mini masterclass by clicking the link in the description. See you in the next one.